Welcome back. Today we will look at 20 important questions related to Chapter 4 of Fundamentals of Research. This quiz will help you strengthen your concepts for finance and NISM exam preparation.
Round 1, easy questions, the foundations. You can pause after each question and take your time to answer before the solution appears. Let's test your understanding.
Question 1. Investing primarily involves A. Gambling on prices. B. Short-term speculation. C. Commitment of money to earn returns over time. Or D. Only trading in stocks. Pause now if you need more time. The correct answer is option C. So the big distinction here is that investing is really about committing your money today with the expectation of earning returns down the road. Unlike speculation, true investing is a thoughtful, long-term process. It's all about safety, managing your risk, and looking for solid income and growth potential.
Question 2. Passive investing generally involves A. Selecting individual stocks actively. B. Investing in a broad market index. C. Frequent buying and selling. Or D. Speculating in derivatives. Pause now if you need more time. The correct answer is option B. Passive investing is exactly what it sounds like. You're not actively trying to pick the winners and losers to beat the market. Instead, you're just aiming to replicate the market's returns. You typically do this using things like index funds or ETFs that track major broad indices like the Nifty or the Sensex.
Question 3. Technical analysis mainly studies A. Company management. B. Price and volume patterns. C. Government policies only. Or D. Dividend payout ratio. Pause now if you need more time. The correct answer is option B. This is a classic concept. Technical analysis operates on the idea that market prices already reflect all the available information out there. So, instead of looking at the company itself, analysts focus purely on historical prices, trading volumes, and chart patterns to figure out where the market is heading next.
Question 4. Fundamental analysis focuses mainly on A. Short-term price fluctuations. B. Long-term intrinsic value. C. Intraday trading. Or D. Chart patterns only. Pause now if you need more time. The correct answer is option B. Now, this is the direct opposite of what we just talked about. Fundamental analysis is all about digging in and estimating the true underlying intrinsic value of a business. To find that fair value, you're looking at the company's financial performance, what's happening in their industry, the broader economy, and even how good their management team is.
Question 5. Which of the following is an example of speculative activity? A. Long-term investing based on business fundamentals. B. Buying a stock solely expecting short-term price movement. C. Passive investing in an index fund. Or D. Investing for retirement. Pause now if you need more time. The correct answer is option B. Speculators aren't really concerned with the true intrinsic value of a business. Instead, they're stepping in to profit purely from short-term volatility, quick price patterns, and overall market sentiment.
Round 2. Hard questions. The deep dive. You are doing great so far, but now we're getting into the more complex stuff. Try answering before the explanation begins. Let's dive in.
Question 6. Active investing aims to A. Match market returns only. B. Avoid research completely. C. Generate returns higher than benchmark. Or D. Invest only in debt instruments. Pause now if you need more time. The correct answer is option C. Remember our chat about passive investing earlier? Well, active investors take the exact opposite route. They aren't happy just matching the market. They want to beat it. They use intense research, careful security selection, and market timing to generate returns that actually outperform their benchmark. Question 7. Which statement best describes passive investing? A. Frequent trading strategy. B. Relies heavily on stock picking. C. Broad asset class investing with limited security selection. Or D. Purely speculative activity. Pause now if you need more time. The correct answer is option C. With passive investing, you're actively minimizing your decision-making. By just buying broad index funds or ETFs, you get some fantastic advantages like lower costs and overall simplicity. Of course, the limitation is that you generally won't beat the benchmark, but hey, that's exactly how the strategy is designed to work. Question 8. Research in investment activity mainly involves A. Only analyzing available data, B. Gathering and analyzing information, C. Following market rumors, or D. Predicting prices without data. Pause now if you need more time. The correct answer is option B. Solid investment research is a two-part process. First, you actually have to go out and gather the information from places like annual reports and industry data. Then you sit down and analyze all that gathered data to draw meaningful, actionable investment conclusions.
Let's look at a fascinating legal boundary for question 9. Mosaic analysis refers to A. Using only public info, B. Combining public and non-material non-public info, C. Trading using insider info, or D. Ignoring qualitative factors. Pause now if you need more time. The correct answer is option B. It's all about combining public and non-material non-public information to draw your conclusions. This is perfectly legal, like piecing a puzzle together. But the absolute second you use material, unpublished, price-sensitive information, that's when you cross the line into illegal insider trading.
Question 10. Technical analysis assumes that A. Prices move randomly, B. Prices reflect all available information, C. Only management quality matters, or D. Market trends do not exist. Pause now if you need more time. The correct answer is option B. Technical analysis is built on three massive assumptions. First, the market discounts everything, meaning current prices already reflect all available info. Second, prices move in established trends. And third, history tends to repeat itself.
Question 11. Support and resistance levels in technical analysis represent A. Government regulations, B. Accounting standards, C. Price levels where buying or selling pressure emerges, or D. Intrinsic value calculations. Pause now if you need more time. The correct answer is option C. Think of this as a visual map of market psychology. Support is basically a strong buying zone where demand steps in to stop prices from falling further. Resistance, on the other hand, is a strong selling zone where supply stops prices from going any higher.
Question 12. Moving averages are mainly used to A. Predict company earnings, B. Smooth price fluctuations, C. Calculate dividends, or D. Estimate GDP growth. Pause now if you need more time. The correct answer is option B. As we all know, stock prices jump around a lot from day to day. They're noisy. Moving averages smooth out those short-term price fluctuations, which really helps analysts clearly spot the direction of a trend or potential trend reversals.
Question 13. Fundamental analysis believes that A. Markets are always perfectly efficient, B. Intrinsic value and market price can differ, C. Price charts are sufficient for investing, or D. Future earnings are irrelevant. Pause now if you need more time. The correct answer is option B. This directly goes against the efficient market hypothesis. Fundamental analysts believe that sometimes the market gets it wrong. If their calculated intrinsic value of a company is higher than its current market price, boom, you've found yourself a profitable investment opportunity.
Question 14. Which is not typically part of fundamental analysis? A. Industry analysis, B. Company financial analysis, C. Chart pattern analysis, or D. Economic analysis. Pause now if you need more time. The correct answer is option C. Like we've covered, fundamental analysis looks deep into the economy, the specific industry, and the company's actual financial performance. Chart pattern analysis? That belongs strictly over in the technical analysis camp.
Question 15. Quantitative research primarily relies on A. Emotions and intuition, B. Mathematical and statistical models, C. Insider information, or D. Political opinions. Pause now if you need more time. The correct answer is option B. What's cool about quantitative research is that it takes human emotion completely out of the equation. It relies entirely on statistical analysis, financial modeling, and complex simulations to predict outcomes as objectively as possible. Question 16. One major limitation of quantitative analysis is A. Lack of mathematical tools, B. Inability to use historical data, C. Frequent changes in business environment reduce comparability, or D. It cannot analyze numerical data.
Pause now if you need more time. The correct answer is option C. Here's the catch with quantitative models. They depend heavily on historical data. So, when the rules of the game change, like if market structures evolve or accounting standards shift, those past trends might completely fail to predict the future.
Let's look at question 17. Behavioral finance primarily studies A. Bond duration, B. Psychological biases affecting investors, C. Government fiscal policy, or D. Commodity storage costs. Pause now if you need more time. The correct answer is option B. This is all about the human side of the markets. Behavioral finance dives into irrational investor behavior. We're talking about powerful psychological biases like fear, greed, overconfidence, and herd mentality, which constantly create inefficiencies in the market.
Question 18. Gold is often considered a safe haven asset because A. It generates fixed coupon income. B. It performs well during economic uncertainty. C. It is risk-free equity. Or D. It is backed by governments. Pause now if you need more time. The correct answer is option B. When panic or uncertainty hits the economy, investors naturally run for safety. They shift their capital toward gold, which drives up demand and prices. It essentially acts as a classic inflation hedge and a very reliable store of value.
Question 19. Contango in commodity markets occurs when A. Spot price is greater than futures price. B. Futures price is greater than spot price. C. Futures price equals spot price. Or D. Commodity demand disappears. Pause now if you need more time. The correct answer is option B. Contango happens when the futures price is higher than the current spot price. This is usually driven by the cost of actually holding the physical commodity over time, things like storage and financing costs. And if you were wondering, the exact opposite scenario is called backwardation. And our final question, question 20. Commodity prices significantly impact equity markets because A. Commodities are unrelated to businesses. B. Commodity prices affect company input costs and profitability. C. Equities determine oil prices. Or D. Commodities only affect agriculture companies. Pause now if you need more time. The correct answer is option B. It's a very direct, real-world connection here. Commodity prices heavily influence how profitable a company can be. For example, if crude oil prices shoot up, airline operating costs skyrocket. That's exactly why commodity price movements ripple directly into stock markets.
Great job completing these Chapter 2 questions. Keep practicing consistently to strengthen your understanding of securities markets and financial instruments. See you in the next quiz session.